Welcome back, everyone. Up next, we have a session that dives straight into what every investor aspires to achieve: unlocking exponential returns. This session is titled Formula for Generating 10x Returns Over the Next 10 Years. And this session aims to explore actionable strategies, innovative frameworks, and the key themes that will drive wealth creation in the decade ahead. As we navigate the dynamic landscape of investments, the next 10 years bring immense potential, provided we position ourselves wisely. This discussion will focus on how to spot opportunities early, leverage compounding, and embrace the evolving role of technology, innovation, and niche themes to achieve extraordinary outcomes. To guide us through this exciting conversation, we have an expert panel of industry veterans. We have with us Mr. Satwik Jain, founder and executive chairman, Generational Capital. Mr. Jain is the founder of Generational Capital and leads the investment committee at Generational Capital Bharat Breakout AIF. With a rich background in equities, alternative assets, and M&A, Mr. Jain achieved the milestone of financial freedom at the age of 26. He also brings a unique perspective as a professional golfer and a venture partner. We have with us Mr. Neil Bahal, founder and fund manager, Neejan Capital. Mr. Bahal established Neejan Capital in 2007 and transitioned into portfolio management services in 2017. Known for his focused strategies on special situations and technology investments, Neejan Capital's PMS has earned a 5-star rating in the multi-cap category by CRISIL and PMS Bazaar. And our final panelist, Mr. Siddharth Oberoi, founder and CIO, Prudent Equity. He comes armed with over 28 years of experience in Indian capital markets. Mr. Oberoi founded Prudent Equity in 2012 to guide investors in building sustainable wealth. Under his leadership, Prudent Equity has consistently outperformed benchmarks over each 3-year period. This session promises to be packed with insights and actionable takeaways, helping us all understand the pathway to multiplying wealth over the long term. And this session will be moderated by Ms. N. Mahalakshmi, Senior Consulting Editor, Money Control. Ms. N. Mahalakshmi, a seasoned financial journalist with over 25 years of experience, is a senior leader at Network 18, heading markets and economy coverage at Money Control. Previously, she served as editor of Outlook Business and Outlook Profit and led markets and investing coverage at Business Standard. She holds the rare distinction of being among the first Indian journalists to interview Warren Buffett, along with other global investment icons like Howard Marks and Joel Greenblatt. It is now my pleasure to hand the proceedings over to Ms. Mahalakshmi. Ma'am, all yours.
Thank you so much, Aishwarya. First of all, thank you very much for this opportunity to moderate this a session that promises to be super exciting because the title itself is super exciting. The fact that you're looking for 10 baggers, which is what everybody wants all the time. But the 10-year part, I don't know how many investors really have the patience to think about 10 baggers in 10 years. But what we all have obviously learned in investing, it's compounding. That's a big contributor to returns. But first of all, thank you, Kamal. Thank you, PMS AIF, for giving me this opportunity. Super excited to be doing this. And thank you, panelists, Neil, Siddharth, Satwik. Wonderful to join you guys. And I'm hoping to learn as well. So please bring it on. The first question really is if each one of you can quickly, in just about 3-4 minutes, articulate what is your framework for thinking about 10 baggers. So for now, let's just keep aside everything else, the markets, the context, and all of that. What is your basic, bare bones way to approach a 10 bagger portfolio? Neil, should we start with you?
Sure. Hi, Mahalakshmi. I mean, I didn't know you had interviewed Joel Greenblatt, so that's a conversation for later. I'll get in touch with you because he is one of my gurus in the market. All right, so everything comes down to getting a good bargain to begin with. And in a bear market like right now, there's value to be found at most places. But when markets typically get fairly valued and sometimes overvalued, you tend to look at special situations to get bargains. So the first starting point is, am I getting a reasonably good bargain where some part of the business I'm getting for free. Then, of course, you have to marry valuation with growth. I don't believe only in buying into a cheap asset or only into getting into a growth stock. If we can marry an attractive valuation with growth prospects, then of course I think that is the starting point of how we get to where we want to achieve. So the and since you said us in a nutshell, so this in a nutshell, we try to find a bargain first and figure out where there could be growth going forward.
Fair enough. Quickly, Satwik, would you like to go next?
Yeah, sure. So broadly, Mahalakshmi, if we are investing in any business or participating in any business, there are only two ways we can make money. One is the entry valuation we are getting in and the exit we are doing. And the second is what is the rate of the earnings growth. So I personally have this framework of 25 cube, which is basically 25% sales growth, profit growth, return on equity, and ideally at less than 25p. So if we can get these three to four, like 3 out of 4 parameters in a company, and if the company executes well, right, based on triggers like a management changes happening, a private equity is taking over, or some margin changes happening, then I think serious wealth can be created. And if you see the leaders of the past bull runs also, like same pattern they had been created, that historically they had been growing very fast, and then some trigger happened that the orbit of the growth changed or the margin expansion happened. So then serious wealth is created. Then to minimize the risk, then we have developed an in-house forensic accounting framework based on 16 ratios, where we try to marry the balance sheet, P&L, and cash flow of a company to see whether the companies are doing frauds or trying to show us what we want to see, which is basically growth in sales and profits. Along with that, there is a 150 keyword fraud search, which we check the integrity of the promoters. And finally, look at the moat of the company and the right to win of the company. And then mostly the focus is on the consumer, healthcare, and technology sectors, because we have seen over the last 120 years of Dow Jones data that these three sectors are kind of anti-fragile in case of recession also. So we want to have the best of both worlds, which is a very low volatile business also, as well as superlative earning growth also, getting in at cheap valuations.
Fair enough. Quick. Siddharth, would you want to go? Siddharth?
Hi. So, when we are saying 10x in 10 years, we effectively are saying that the capital should double every 3 years, or the capital should compound at 26% per annum. So for us, that's a pretty long period. So we break it into several short-term periods into 3 years. So for us, long-term is a series of several short terms. Here if we invert this 26%, we would like to see buy companies which are growing at about 20-25%. That is one way to achieve it, but that is just one part of the puzzle. The second is that we need to buy it at statistically cheap prices. So, the cliche now is that buy growth is a reasonable price, but for us, we need that growth at a very cheap price. So, for example, when you put your capital into FDs, that doubles your capital every 9 years. So when you're taking the risk of equities, would you want to, double your capital at much, much higher speeds? So with that, we go about valuing companies. We understand the business and we try to figure out a business value of the company. In the investment parlance, is called the intrinsic value.
Yeah.
So our catch is to buy these at a 40 to 50% discount to those conservatively estimated values. So we do that, and in between we have several special situations as well, where we try to create alpha, turnaround companies where there's a change of management, etc. So a combination of this, we are able to achieve this kind of a return.
Okay, fair enough. So largely, I see that all three of you have similar sort of framework, in the sense that all of you are looking for growth, not necessarily hyper growth, but I think even 25% in a very significant growth, especially when you look at long time periods. The other thing all three of you are saying is that you want reasonable value, but this is largely the combination that everyone talks about. All investors want reasonably strong growth at attractive valuation. So that's not rocket science. So I want to understand what is that unique part of your approach, and how do you, approach stocks in a way that you are able to get this combination? And if you can illustrate that with maybe a few examples. Neil, would you want to go first?
Um, yeah. So as I said, uh, there has to be a framework that allows you to find bargains. So for us, around our special situations, it's almost entirely focused on finding bargains where there's a corporate action. Because there is a general consensus that conglomerates trade at a discount and the breakup value of companies are usually higher. So there was a study done in the US that, what if you blindly bought all special situations? Don't do any study. You bought all of them over a 25 or 30-year period. It was done by the Penn University. And the result was pretty astonishing that blind buying of special situations and a holding period of 3 years, you end up beating the S&P 500 by a factor of 2x. So if you kind of then uh, actually analyze businesses and get into the right ideas, then you can do what someone like a Joel Greenblatt did. Yeah, his CAGR was 52% over, I think, 12 years or so. Uh, so the point is we have to find bargains and we have to look at special situations. I'll give an example. Of course, we cannot talk about anything that's happening right now in our book. There are a lot of SEBI regulations on that. So I'll talk about what happened probably 7 years ago, a particular transaction we did. It was a company called Green Ply.
Yeah.
Green Ply decided that, okay, we'll split our MDF business separately and we'll keep our plywood business separately. There was a family split also probably happening at the same time. So I think I can't remember exactly. Price was about 150 to 180 kind of range. And on the day when they actually went X and Green Panel got out of it, the market thought process was that MDF is too soon and MDF won't be so good, and it's a big plant and it's not the same as not as good as the plywood business. So the market got a big relief when Green Panel went out, and instead of adjusting down, that particular company adjusted higher. Green Ply went from 150 or 160 on the date of going X for Green Panel. It went up as a standalone entity more than 200 rupees. And that also coincided in a bear market. So in a bear market, doing special situations is even more rewarding, if you ask me. And then, of course, Green Panel listed at 30, probably went up a little bit, then came down during the COVID crash to 25, and then went to 600. So when you do these kind of things, I think you increase your odds of of delivering good returns. But also there are more factors. It's not as simple as buying something, as you said, buy something cheap and sell and hope that it has growth, and then you will sell at around the top. There are other factors. There are one more thing that we look at is something called the incremental CAGR. Every 2 years or 3 years, there should be a process of re-looking at the entire portfolio. At least start with a paper thought process that if you have a 20 stock portfolio, now after the 3 years, which of these 20 stocks would you buy fresh? Many times, their stocks have gone up 5x for you, and you don't want to buy more of it. You want to, just hold it. But if you don't want to buy more of it, should it be in your portfolio to begin with?
Oh, absolutely. Correct.
So that's a
Howard
concept.
Marks talks about it. A lot of investors have spoken about this, that it is intellectual dishonesty to be holding a stock that you would not buy afresh.
Exactly. So after every 2 or 3 years, kind of Joel Greenblatt spoke about this when he spoke about magic formula investing. Just wipe the slate clean and start again. It also, there is a very good analogy that I keep telling people around me. It's like a game of chess. When also coinciding with something called beginner's luck in investing. What is beginner's luck? Beginner's luck is basically you are seeing a situation and you're buying according to the situation. So you're mostly going to be right. It's also like a game of chess. The opening part of a chess game, whether you do the king's opening, queen's opening, the retaliate, the moves against every opening is there. The complexity starts when you get to the middle game, and when you get to the end game, it becomes even more complex, where things start changing. You cannot just play pre-decided moves anymore. So that's exactly what happens to a portfolio. In the year two, in year three, in year four, policies keep changing, founders keep changing, new businesses you keep getting into. So many things in a cycle keep changing. So if you have a habit of looking at incremental CAGR and kind of wiping the slate clean and figuring out, will I buy more of this stock after 4 years? And if the answer is no, you should. So all of these factors help you a very long way to creating alpha.
Sure.
If
Thank
you
you
ask
so
me.
much. So I will just allow me a few more minutes. Neil, I'll come to you, Siddharth and Satwik. Some questions and clarifications around what you said around conglomerates going for spin-offs. There are multiple strategies around this. Some people buy the business. The way you explained it, it occurred to me that you are betting on 1+1 when a split happens becomes larger than whatever it was, and therefore but you can play this in multiple ways. You can bet on it. Once it splits, you can sell both businesses because both of them are more than the price at which you bought, so you pocket that gain. Some people bet that the bigger business, like in this case, the bigger business or the more profitable business sort of gains more in value because a loss-making business just went out, and therefore the investors are latching on to it because it's a pure play on a profitable business. The third way to play it is also that you buy the unloved business because everybody is dumping it, it is going out of the index or something like that, so it becomes cheaper than what it is worth. So in our markets, since you've been doing this for a long time, what kind of opportunities do you see more of, and what has been more rewarding for you?
Purely speaking, demergers have been the most rewarding. And the best time, if you ask me, to get into a demerger is around the approval from NCLT. If you buy when a demerger is announced by the company, then there's a 12 months to sometimes 24-month wait for the demerger to go through, and that could be frustrating, and it could have implications on your CAGR that you end up getting. But around the time of NCLT, that's largely a done deal. It takes 3 to 4 months. So I found that if you like a company, which is that you want a demerger, the two businesses that are getting split are largely equal in size. You can go around a time of demerger, but sometimes a company will demerge, which is a small part of the overall parent, and it makes absolutely no sense then to buy it pre-demerger. Then ideally, you want to hope that as it gets deleted from the MSCI index, all these ETFs who just have to follow what the MSCI tells them, they will, once it gets deleted, a lot of their selling comes. And in a bear market, if this happens, you end up getting something for far better than fair value. I mean, far cheaper than fair value. So there are multiple variations that come into special situations, and especially during demergers. And we look at all of them, and there is no right answer. Like for example, in a bear market like today, I will not probably even want to wait for a NCLT date to come. If I like
Right.
something, I'm just going to buy it right now because I know the breakup value could be much higher.
Right. Because the
You know,
market is giving you an opportunity to buy something
correct,
cheap.
correct.
Fair enough.
So you just have to take sometimes decisions based on what is happening around you also.
Right. So, Satvik, you talked about this 25 by 25 by 25 model where you're looking at 25% growth in revenue, 25% growth in earnings with a 25% ROE, I think. That's what you said, right?
Right.
So, do you get and for typically a company that's growing earnings at 25% with a ROE of 25, what is the multiple that you would consider all right to pay? Include, I mean, after
So
accounting for a margin of safety.
Right. So it frankly depends on a sector to sector. The multiples I would be willing to pay, but ideally on a price earning growth ratio, more than 1.2 times on a 1 year forward basis, I would be skeptical to pay. Essentially, on a trailing basis, it could ideally be a 45, 50 price to earning multiple. That would be kind of the maximum. Because again, if we pay very high valuations for the companies, then probably we would not end up making those kind of IRRs. And the scope for disappointment also would be very, very low. The company would have to do flawless executions, and even a couple of quarters of disappointment will lead to share prices tanking because the expectations would not be met. Now, obviously, we are not very, very fixated on price to earning ratios because a lot of accounting standards have changed and different companies have to be valued differently. So retailers, we would consumer retailers because they are a big part of our allocation because they are very easy to understand and we can see the growth prospects ahead. We value it on an enterprise value to EBITDA basis after the Ind AS accounting changes have happened in 2018. When the assets taken on lease are marked as right of use assets and they're depreciated, so the PE will look optically higher. Same way for a IT services company, a P ratio would be fine. For a platform company which is profit making, doing 70%, 80% return on capital employed, a P ratio would be fine. And mostly what I have figured out where we would make money, lose money is when we figure out the longevity of the growth. Because markets are very short-sighted, they look at 3 months, 6 months, or maximum 1 year. But even if we can figure out based on our research, our understanding of the sector and the business, okay, 3, 4, 5 years ahead, the company can sustainably grow into the valuation the prices are factoring in. I think that is what will differentiate us probably from the overall market or the index.
Okay. So, so you're saying that essentially you do not always look at PE depending on the nature of the business and the cycle of business where they are in. So, for example, a Zomato or any of the new age businesses will not qualify there. But in a steady state business, which is sort of, the growth rates are fixed, but there is always, in all companies there is this golden period of growth. And definitely 25% over 10 years is a very long golden period of growth. So, so how do you navigate this?
So,
Do you look at, should you have visibility that this company would grow 25% earnings over 10 years, and then you take a call on what should be the value, what is the value that will create through earnings growth, which is 25%, which itself can give you if the PE remains constant. But you also talked about a PE re-rating, which means you're willing to accept a lower rate of growth. So some part of it comes from re-rating, or you will achieve a much bigger growth, much bigger, return, which will make up for perhaps some of the bad calls you may make in the portfolio.
So I like spend a couple of minutes on the process we take to identify stocks. So then I will get to what you like the specific question. So first we will see that okay, over the last 5 years or 10 years, the company would have consistently grown at least 20% or 25% year on year in terms of sales profit, maintaining a consistent return on equity. And then we
Okay,
would
so what you are talking about is past. The history should give you the confidence. Okay,
yeah,
but then past is not an indicator of the future.
absolutely. So then the research starts that okay, now what is changing here, right? Or what the market is not factoring in that this 20-25% can grow to 30-35%, or probably the business is available at 15-20 times price to earning multiple. That markets are not factoring in the longevity of the growth. So I'll give you a couple of examples. So just a disclaimer before that these are currently also in our portfolio, and these have been long-term holdings in our family portfolio, also our portfolio management service, as well as the recently launched alternate investment fund.
Sure.
So Trent, which is the leading retailer, now it has been included in the Nifty. So we had been holding the company pre-COVID. And the patterns were very similar that West Side was growing very fast. Some of the parts valuation was very attractive. It was available at around 25 times EV to EBITDA. P would not make sense again, like because P would be showing around 110, 120 times, but it had to be valued at EV to EBITDA. And then Zudio had just started scaling up. At that time, they were doing around 250, 300 crore of annual sales. The company was available at around 15,000 crore market cap. Cut to today, at its peak, trend was around 2.5 lakh crore market cap. Today, I think it will be around 1.9 lakh crore market cap, being one of the largest winners for us. The sales of Zudio has grown from around 250, 300 crore to 8,000 crore.
Yes.
More than 800 stores have opened up, and the pattern was very visible. Like what they had done with Westside, the same they were doing with Zudio. Right. Similarly, another retailer, again, it is a very small cap company, so I would not take its name. Basically, a Bihar-based electronic retailer we had entered in 2020, and the idea there was, last 5 to 10 years they had done exceptional work, growing at 25% plus year on year, not a single store closure, and had reached around 200 crore of absolute sales. Now they were, and they had only raised around 8 to 10 crores from their IPO, and they were doing it profitably, 6 month break even. And what I could figure out there, what was their right to win was Chroma, basically Tata and Reliance would not go to Bihar as such, because the capex involved was very, very high for kind of a 2 crore investment per store. Right. So this company scaled up from around 25 stores to 150 stores in a matter of 4 years. The sales have gone from 200 crore to 2000 crore. They are doing more than 100 crore of profit. The stock price has gone up 30 times in that time frame. And we entered at around 8 times EV to EBITDA. Today it's at around 35 times EV to EBITDA, probably priced to perfection right now. So markets kind of do not, I would say, underestimate the longevity of the growth, or a lot of time institutional money does not look at, say, sub-billion dollar ideas.
Right.
Most of the
Have
mutual
you sold this Bihar company yet?
No, we currently also are holding it.
Okay. So what are you holding it for?
Right now also they are growing around 25-30%. So versus the other retailers which are there, right? They are still kind of doing above average results. So after capturing the whole of Bihar, they have become the number one retailer in Jharkhand also, and now they are going to UP till Prayagraj. So broadly, the work they are doing is good. So it can be a compounder story now. It won't be like, that 10x idea in 3 years.
Okay, so in which case, I'm just going to post the point that Neil made in terms of, uh, wipe your portfolio clean every now and then to see whether you will buy that stock now for the reasons that you normally buy stocks, and whether they meet the criteria to ensure that they continue to have that position in your portfolio. So if you don't believe that that the the past growth cannot be replicated, why would you want to hold it? Will it not impair or diminish your returns in future, overall portfolio returns?
So broadly, we the internal IRR expectations are on any stock is 25%, which is broadly without any valuation re-rating. The company should double its sales and profits in the next 3 years. So the retailer we talked about, broadly, the expectations are that they should be able to do that based on what they have been guiding, what their execution has been. So that is why we have been holding as of today.
Okay, so you're saying when you bought the stock, the expectation you had on the stock is similar to what it is now.
Yeah, yeah. But the markets re-rated it, and the company also delivered much better than what we had expected when we had bought the stock.
Okay, fair enough. Siddharth, you talked about, essentially inverting this 26% CAGR, which is what 10 bagger in 10 years really converts to ensure that you buy stocks which grow at 25%, which is pretty much the same formula that, Satwik is talking about. He's also talking about earnings growth of 25%, right? How is your approach different from what Satwik explained?
So see, we want to hunt in shallow waters. We're afraid of heights. And as I'll quote Charlie Munger, as he said, that if you want to shoot fish, you shoot them in a barrel which has no water. So So how easy it is to shoot them. So with that, I just give an example which actually proves our strategy. So there was this company called Time Technoplast, which we have sold by now, but we bought it about some 80 rupees, which was actually 7 times multiple. So a company organically growing at 15% CAGR, having a 60% market share in its products, and one of the new products it had launched was composite cylinders. It had double the capacity, was fully sold out. It was tripling the capacity, and that too was sold out. Now, now you had everything in the bag. You had earnings growth, you had valuations, and the management in subsequent con calls came over and interviews came over and said that now they're focusing on capital allocation, etc., paying back shareholders. So those sound bites were really good. And then what happened was that the company decided to sell its overseas business for a sum of 1,000 or 2,000 crores, whatever. So they had hired a banker for that, and it was in the news. So you had a company which was essentially a 1,500 crore market cap company selling its 35% business for 2,000 CR. Uh, and then you had earnings growth and you had valuation comfort. So everything was in place. Where we took the bet. So um, effectively, we sold it at about 400 rupees after 18-month period. But the point to say was that it went from 7 times to almost 20 times. The earnings trajectory played out. They didn't sell their business, but nevertheless, the ROC went from, I think, 10, 11% to 20%.
Right.
So had everything play out. So this is the kind of stocks we like, where everything is in our favor. It's a mispriced bargain, and we have got it at a good price.
Right. So I think this should be our last round in terms of just contextualizing what you're saying to current markets, which is where the challenge is. Of course, we are talking at a time when the market is off. At least a lot of small mid caps are down about 20% on average, at least the index level. Have we come to a point where you are able to find 25% earnings growth with good return on equity, at least upwards of 25%, like Satwik articulated? Are those businesses today valued at an attractive enough price for you to make 25% returns over the next 3 years? Let's just cut it down to just have some near term or medium term visibility.
Yes, we have few of them, but we're still sitting on 35% cash, which means we are still not finding those lucrative businesses at our desired prices. And just to put this in perspective, uh, in India, the bull market has consecutively lasted for more than 5 years. So there was this 91-95 period. Then there was a 98-2000 period, which was the TMT bull market. Then we had the 2003-8 period, which was more broad-based. Then we had the 13-18 period. This one started in April 2020, and we are ending the 5-year period there. So we may be lucky this time that uh, India breaks its 5 year string and goes ahead further. But I think that the earnings that have come in and the kind of valuations we are in, I expect that the market is headed downward before it goes up. And so in that, we may get opportunities to invest in the businesses we like.
Okay. And what kind of correction would you expect, let's say, for an NSE mid cap 250?
So we don't know. Nobody knows, and nobody can predict this. But
No, roughly. I mean, roughly, because we all have some sense of history and say, okay, the longer term trajectory is this. We are maybe 10% overvalued compared to history. Do you even look at historic valuations as an anchor, or
no, we don't. We
completely?
don't. But broadly, if individual stocks were to fall 15% from here, I think we would be able to deploy everything. So we are around at that place where if individual stocks were to fall 15-20%, I think I
You
think
are a
our capital
buyer.
would be fully
You are
allocated.
a buyer, and the
Absolutely,
35% cash you have, you'll confidently deploy all of it and hope
absolutely,
to work.
absolutely, because this will be bargain prices there.
Okay. Satwik, what do you think of prices today? Does it allow you to buy stocks to compound at 25% growth over the next 3 years?
Well, absolutely. In fact, contrary to Siddharth, I am more on idea than short on cash. So there are so many attractive opportunities right now available at 10, 15, 20 times price to earning multiple, with companies putting up large capex, and the expectation is they should do at least 2 to 3 times sales and profits in the next 3 years. So that is the space I'm looking at, without taking names in the fastest growing co-working player, the fastest growing spice maker in the country, luxury watch retailer. So these kind of companies are there, where very good opportunities are there. The fastest growing domestic cancer drug manufacturer, and all debt-free companies.
So one follow-up question to that. Usually when tides turn, a lot of companies which have expansion plans, capex plans, all of them, along with the downturn in the economy, gets shelved. And usually slowdowns do not last for just 1 or 2 quarters. It tends to be a 4 to 6 quarter kind of a thing. Do you think this time is different, that you can believe what companies are saying in terms of their expansion expectations on growth, capex, etc., will indeed come through, for that 25% growth over the next 3 years to come through?
Especially focusing on the consumer sector broadly, I've seen the companies catering to the top 1% or the bottom 5-10%. They are kind of not very much impacted, because those two segments are consuming what they have to consume. So essentially, the focus is on identifying those kind of companies where the demand is of anti-fragile. Right. So for example, 11 Jacob and Co watches were uh,
Sorry, I'm
launched and launched
losing
one
your. Okay.
price around 88 lakhs.
Sorry, your audio is not very clear to me. Can you hear me?
Okay. Yeah, I can hear you.
Okay, I lost you for a bit. Sorry, can you just repeat what you said? Just the last part.
Yeah, so the focus is on the companies focusing on in both these segments. The demand is kind of uh, uh, very sustainable in the future, as per our analysis. So, for example, 11 Jacob watches, each luxury retailer. So the demand is not slowing down at the top 1%, neither bottom 10%. Where leading footwear manufacturer, they are growing at 25% plus, when the whole footwear industry is declining, because their average selling price is around 700 rupees.
Sure. Okay. Okay, so you do see opportunities for companies which are catering to these two segments, absolutely premium end and absolutely at the bottom. So that's
Right.
that's your focus area. Neil, for special situations, usually I think you also started off saying that bear markets are great for special situation. By the way, I'm not saying this is a bear market. At least some pockets of the market have gone down more than 20%. So that's definitionally called bear markets. But are these markets conducive enough for your kind of investing? And do you see a lot of opportunities to make 25% returns over the next 3 years?
So, I kind of agree with Siddharth. Uh, Late last year, we went big into cash. Around October, in our PMS, we went 27% cash and then defensives and arbitrage positions. So, in effect, it was more than 30%. In our AIF, we were almost 45% in cash. Right now, also, we're at 36%. We have started deploying, but I kind of agree with him that high quality businesses at the price that you want are still not high quality businesses have not become cheap yet.
Yeah.
You've got your average companies which have become cheap and attractive. So yes, a lot of stocks which are considered to be okay are available. But if I'll take a name. I'll take a name because I have no position in it, right? I may buy it later. But let's say, if in my opinion, Tips Music is one of the most fantastic businesses I've seen in a long while. I used to own it earlier. Now we don't own it, but I still find it ridiculously expensive, and it needs to fall. If
Yeah.
someone like me would want to kind of just blanket shoot at sight approach has to be given. So I still don't think the exceptional businesses have come to a level. So we continue to hold cash, but yeah, there are pockets. I
But
agree
I
with
mean
both
that.
the panelists.
But is that wishful thinking? Because those kind of businesses may not fall because
Yeah.
nobody's going to sell.
Correct. So if they don't fall, then we kind of figure out if something around decent businesses offer great return possibilities, and then we keep doing these special situation kind of trades, 3 year holds where you kind of do one and then you find the next one. So there are different ways, but for us, I'm still in cash, and we've not been very aggressive. We've been buying, but not very aggressively, and thankfully, because of that, this correction has kind of harmlessly passed us by without causing too much trouble. At least in our AIF, PMS has come down a bit, but luckily not as much as what I would have thought otherwise.
Sure. Thank you so much. I think I'm already getting nudges. We've overshot our time by 5 minutes, but thank you so much, gentlemen. I think the broad framework is to focus on that 25% earnings growth and keep a margin of safety. That should sort of hold you in good stead. And of course, look for special situations opportunity because they are really a sitter. How quickly and how agile you are about those investments can make a lot of difference to your returns. On that note, Satwik, Neil, Siddharth, thank you so much. And over to you, Aishwarya.